Welcome back to FinTalk, brought to you by VERMEG. Here we discuss pressing topics in fintech, regtech, covering regulatory, collateral and digital across banking and insurance and finance. VERMEG has been proud to deliver innovative software solutions in the industry with stability and cost efficiency for a global roster of clients. With over 20 years of trusted transformation in finance and insurance, we're bringing industry's top expertise to FinTalk. I'm Gerald Akhtar and I'll be your host for this podcast. So today we're going to be talking about the Dear CEO. It's been about a year since we last saw the letter land on everyone's desks. Today I have with us, I'm quite delighted to have gentlemen from my compliance office, Paul and Richard. Paul, if I can ask you to introduce yourself and a few words about what you guys do at MCO.
Yeah, sure, Jared. So my name's Paul Manson. I've got around 30 years kind of client-facing management experience in the financial technology space. My background is principally around the kind of regulatory challenges that institutions face in risk management, regulatory reporting, GRC, AML, and trade surveillance. My compliance office, one of the kind of foremost compliance management firms out there in the market. We've got over 450 clients now in over 100 countries with a very respectable global spread. And we're typically active around employee compliance, third-party risk management, transaction compliance, and also risk compliance, also from both a regulatory and a risk management perspective.
Excellent. Thank you, Paul. That's definitely quite interesting insight into yourself and MCO. Richard.
Yeah, thanks a lot. So Richard Pike is my name. So I am the managing director of the KYR suite of products within MCO. I'm also the chairman of Citadel Securities in Europe, and that gives me an SMCR and an Irish CBI view from the regulator. And I'm also the deputy chairman in the biggest domestic Irish insurance company, which is also a PLC called FBD. So I have an experience of both, I suppose, the software project implementation side of things, but also from a board and governance in terms of, signing off on some of these reports and some of the processes and approaches. So that's my background.
Thank you, guys, and welcome. I want to dive into the Dear CEO. I know it's been a year since the last time. I know there's always been, every year there's a Dear CEO letter, right? I want to touch upon kind of your thoughts, and then we'll dive into a few more kind of particular points. I know you guys, MCO, you've got a vast coverage of client base as well. So initially, have MCO been dealing with it, and your thoughts over the last year or so?
So the big difference for us is actually that MCO acquired my company, which was called Governor Software, which was focused on policies, risks, controls area, and that whole, compliance governance as well. Because, the GCO was one of a number of things in the last while where the focus from the various regulators around the world has been on governance and control. Even in the more, let's call them financial, market risk, credit risk, reg reporting would have been traditionally held, but, looked at analysts and, a lot of maths or a lot of process. People are now clearly focused on the governance area and the control area. So we got acquired back in September. We've spent the last 9 months integrating that technology into the MCO platform so that basically our customers can add the governance and control lens around their reg reporting or any other part of their process. And so that's really the big change we've made. What we're seeing actually is a mixed bag, I'll say, from the customer base around the Dear CEO letter. Some people taking it very seriously and upping the game, others not so much. I think the interesting thing for me in that letter that has in some cases resonated and in others hasn't is the link that the regulator made between the approach to your financial accounts, sign-off process, review process, all that stuff, right, compared to your regulatory reporting. And they were putting them on the same level. And I've seen quite a lot of firms who didn't get that. You know what I mean? They still haven't raised the bar on transaction reporting or reg reporting compared to the way they do financial reporting. Whereas some got that. It was pretty clear in the letter, but some really took that to heart and said, right, let's go through what we do for our reg reporting and compare it to what we do for the annual accounts. And particularly, like for me, as the director of a quoted firm on the LSE, there's another bar above, right? And that also shows firms an approach you can take in terms of right sizing your reg reporting governance, right? If you're a small subsid with a small sort of transaction base, you can take a relatively straightforward approach like you would if you're a subsid in a private company. But if you're a big, significant firm doing lots of different things, well, you should probably have a process that's akin to a PLC in terms of their financial year-end audited report, right? So that surprised me. I thought everyone might get that because it's pretty clear in the letter. That's certainly the big one I've seen.
Yeah, no, I kind of broadly agree with Richard there. So the rigor that has been put on kind of normal financial reporting just hasn't been there for transaction reporting. And, it's clearly equally important. And also, this isn't a new problem. The complexity and challenges around transaction reporting, getting that data from that journey all the way up until it's actually going into a bank statistical report for the regulators, that's been a complex process for a long, long time. And I don't mean in terms of data processing, but principally around people and ownership, which is also the whole kind of thread of the letter. So certainly my observations have been that this isn't a new problem. This has been kind of around, but it's for a while. But the letter certainly brought it into kind of sharp relief.
Yeah, and I agree. We've had the same kind of response here from our client base. But I mean, that point about the reg reporting not being akin to financial reporting, and it was very clear in the letter about what they wanted, right? But I mean, that's been going on for a long time. Pre me anyway, definitely. It's something that I don't think is going to happen overnight, just because the scrutiny around financial reporting and disclosures and kind of all that comes with it. But it will take time. And I think I do want to kind of dive into those little points that you just picked up, both of you, is the governance side of it. Let's dive into the governance and controls. So how do firms apply those controls that are fit for purpose? I know there's a simple answer, right? It's kind of get your house in order, and if you're doing it for financial reporting, it'd be the same. Obviously, financial report comes with full audit checks and everything else. So yeah, I kind of your thoughts on that.
I think one of the issues is there are people out there with degrees and diplomas around financial reporting, right? And that's a whole thing. And so you're not surprised when there's a team and they know what they're doing and they're organized and they have, they've a good process in place. There's no such thing for reg reporting. And so now, that's the bar, right? That said, it's exactly the same process can be applied, right? In terms of things like data checks, which happen all the time in financial reporting, assumption and sort of key assumptions, key judgments, papers would all happen. I constantly read them in my board, things about the key assumptions we're making, systems reviews, proper governance. So actually, in any firm, you could sit down, look at that financial reporting process, end of year process. You're right. You might take out the whole external audit stuff because probably isn't relevant. That said, you might employ it now and again. Wouldn't be a bad idea in the reg reporting side. But you can take that and just apply it over and see, well, what have we got done? Now, do we do key assumptions or key judgments? Do we call out those papers? Do we do, model data reviews? Do we do, et cetera, et cetera? So I don't think it's the hardest thing to figure out what you do. I just think there's a lack of push in terms of the cost, the complexity. I mean, I've certainly talked to some firms who feel, I get a fine, or I get, it's a kind of, if it happens, fine. It's not a big thing. Yeah. And I was kind of hoping the Dear CEO letter might change that, and maybe a few more slaps on the wrist from the regulator might wake people up to that. But I don't think it's taken as seriously as the financial reporting stuff. And partly I think that is because there are people in the business, in every business, who are, accountancy people, and that's what they do. And even for their own personal, professional view, they want to have it right. Yeah. And that doesn't seem to come with the regulatory reporting stuff.
Yeah, and I'd kind of add to that. I mean, there was a mention of skilled person reviews that the bank has been doing. So obviously that's a different situation. So there's a lot of focus on when that's absolutely hit the board's attention. And it's kind of back to what Rich had said at the beginning. It's a bit of a mixed bag about how seriously people take this. I certainly think for some, this letter will have galvanized, if there's been other issues in the past, maybe it's an internal audit, which has brought up a few points in there in terms of the reg reporting process. It will galvanize, certainly at the board level, maybe Richard could comment on this, is to actually attract budgets and investment. But I guess the senior management team will beg the question, okay, if we're going to spend some money on remediation work here to avoid getting a Section 166 or a skilled persons review, what do we need to focus on? Because, this is a horribly complex topic. So I'm kind of wondering whether you look at the timing, that maybe people are still going through that process of trying to work out what they need to do rather than actually funding it. And I don't know whether you've come across that, Richard, in your board discussions.
Yeah, I mean, I presume everyone will have done, what certainly I see in most cases is you get a letter like that, you do it, you commission normally the compliance team to do a gap analysis, right? To say all those points that it made, where are we? Yeah. That might take 3-6 months. Then you take a look at the gap analysis, and if there's loads of reds and ambers or whatever way you report it, you say, God, okay, we need to sort this out. And you're right, there might be another, call it 6 months of running around trying to figure out exactly where to spend the money or what's the best thing to do. And certainly you would expect that, I would certainly as a board member expect that if a regulator happened to come in a year after a Dear CEO letter, that they see actions happening. Yeah, they would want to see that gap analysis, the next steps, those discussions at senior executive team, even if nothing had concretely happened. They'd expect a project in train, or else that you said, no, it's brilliant, we're the best in the world at this, which, is going to be rare, right? So, yeah, you're right, there may be a lag, but I certainly would have expected to see everyone with this is what my target operating model is for good quality reg reporting after that letter. And now, how do we implement that? And if people weren't at least at that, I would be concerned that the regulator would be jumping all over them.
Yeah, and I think if a lot of budget cycles are kind of September to September, then if they've done the gap analysis, just playing out what you've just said there, Richard, so they've done the gap analysis, or they've commissioned that, they've gone into a bigger dive, they come into, okay, let's look at the top 5 things that we're going to do. I think a reasonable assumption is that they've got a list of what they need to do and they've got a budgetary number against it, and they're going to go through that process now. But this is kind of best practice. I think that would be a reasonable assumption.
Yeah, no, I agree. That was my point was, Richard, you're on some quite high profile boards. And I think, just hearing from that letter landing, I'm assuming yourself, with experience you have as well, to kind of question your CEO, right? Say, okay, what are you doing? What is the plan? Well, we've seen across firms, some firms that haven't really jumped on it and just said, yep, we're fine. We've got controls in place. But also to understand from your point of view that I'm assuming you would have just said, look, what is the action? We've got a year, and then we go off, we track it, and we'll see what, because every department would get audited in a bank, right, or in a firm. So you'd expect all those gap analysis and all that already to be there. But I think that letter landing, especially from a board perspective, I know from a user perspective, everyone kind of jumps up in arms and let's sort out our manual adjustments and things like that. But from a board perspective, I think, how much impact does that have around the board?
It does, and particularly in the UK market with SMCR. So, as an SMF, right, you're going to look at that and say, right, that's, if I get a review in 2, 3, 4 years, and this clearly came in, right, addressed to the board, to the chair, you're going to have to show some response, right? If you just went, oh no, we're fine at that and threw it in the bin, that's not going to hold, right? So at a minimum, I would be asking for a gap analysis. I'd be asking for someone in compliance to go through that letter word by word and say, yeah, no. And that's coming back to the point that it was really clear in that letter that they expect this to be akin to financial reporting, right? To financial, your end of years. So I would want that's a conversation at a senior executive or a board level to say, right, are we there or are we not? And if we're not, why not? I mean, if you make a decision, it's your decision, right, as a firm to say, no, we're doing X. But you'd want a clearly documented decision as to why we did this. And we're cracking forward with this particular approach. So at a minimum, that's what I'd be looking for. Gap analysis, details, and then decisions not to do things, fine. Decisions to do things, fine, get on and do it. Because if you don't have those, I think you're going to struggle in front of a regulator or an auditor to explain yourself. Yeah, so that would be a minimum. And we're a year past, so those should have been done across the board.
Yeah, exactly, especially under the SMRs, right? So as soon as an SMR gets that, I think you want to try and get as much funding. I get the benefit. There's a cost benefit to it, right? To have tighter regulations in the bank, it does cost. There is a cost attached to it, and obviously there's very little benefit. Initially, there's very little benefit, but if you can keep the regulators at bay and show them actions and things like that, that's the benefit, right? That's the this kind of breathing space that you'll get. But then I kind of want to touch upon the governance bit about how complicated can you make it? I mean, a big bank would do. I wouldn't expect a small branch or someone, a really small operation to do something similar. So where's the middle ground of what they could, at a minimum? I'm kind of not saying, let's lay down the five points and that's what you should all be doing. But it becomes, is it too big for everyone? It has to be, is it on case by case status or?
I think as I said, it's a little bit like the actual financial reporting process. So if you're a small private company, subset of a US firm or something, right? And you're doing your annual accounts, it's a relatively straightforward, simple process, right? Particularly if it's a pretty straightforward business, right? There's not too many key assumptions. There's not too many different regs you got to respond to. It's a straightforward process, and you're rolling up within a big group who give you about a bunch of support, right? That's akin to the idea that in a similar case, if you're a monoline, business, you've got fairly straightforward transactions, you're part of a big group, that should be a similarly simple process, right? As long as you've got reasonable controls around the process. Compared to a bigger firm where you've got multiple different process transactions. I mean, look at someone like Citadel, who are doing an average of 12 to 13% on a big exchange on a day. Different transaction types, big requirement around transaction reporting and reg reporting, and we do a lot of that. So you can see that makes sense, right? And you would probably compare that in our case in Citadel to a big firm's PLC reporting process, right? Financial reporting process. So it should be easy enough to look at your business and say, look, that's relatively straightforward. We don't need to go crazy, or your support from group. I mean, what worries me slightly in some firms that I've seen is that group problem that said, I've got to produce these reports. They're quite complex in the UK, and I'm reporting to group, and group says, oh, no, you're only a small part of us. We're not giving you any resource, right? Sod off. We've got different systems or different people in America or in Asia, wherever their head office is, right? And the UK is like, oh, I need help. I need resource. I need systems. I need, and they're not getting that help. And I would say be very careful as an SMF in that world, right? Because the regulator is not going to take that as an answer. You've got to produce the stuff. You've got to have the local controls, and you need to impress upon your group that this is very serious. I mean, I've seen cases the other way around in the US, a number of US senior execs in a big bank just walking out because group wasn't giving them support, and their local regulator was giving them huge grief. And they just felt that the personal risk just got too big. And the three senior execs walked, CRO, CFO, and CEO. And I would certainly be very concerned if I was an SMF in a subsid in the UK and I was had problems with this reg reporting and I wasn't getting support. But I don't think it's too difficult to level set, to be honest. It shouldn't be. But it is a function of the complexity of your business, not just your size, right?
Yeah.
Yeah, and I think a lot of those firms that have grown by acquisition, and they say they've got an international footprint and they're doing multiple both trading book and banking book, activities, just looking at the banking world. their system complexity is going to be substantial. But they do have sign-off points already. They've already got some process for month-end submissions for these things. But as kind of Richard's alluded to, the personal liability for certainly, say, the SMF roles and the equivalents is substantial. And as is often the case, certainly in the, look at the FCA and the SMF roles, where sometimes when they don't feel they're getting taken seriously by the market, they'll roll some heads, some examples will buy business to say, listen, we're doing this seriously now. So if they didn't get the response they thought was necessary from this Dear CEO letter, maybe towards the end of this year, beginning of next year, although when they're doing their firm reviews, maybe you'll see some of that happening next year. And I'm not trying to scaremonger, but, just looking at past behaviors where they're not getting enough traction, they're not being taken seriously enough. But again, Richard, I'm guessing there, Richard might have a different view.
Yeah, no, I mean, I think you're right, Paul. I think, if they're going in next year to firms for whatever reason, and they spot that what I said hasn't been done, there's no gap analysis, there's no clear understanding of where the issues are, and work going on, I think you're absolutely right. I think they'll be going after heads based on their capabilities around SMCR. I think the other thing they said in the letter, which is interesting, was that within those roles and responsibilities, it wasn't really clear, or there was mixed bags. Joe owns this and Mary owns that. There was a bit of that. I think they'll be jumping up and down about that as well, to say who, it's really clear in financial reporting that it's a CFO and there's no discussion. So why isn't it clear in reg?
Yeah, because it got a lot of it. I mean, there was that paragraph, wasn't it, where it's being SMFs had been kind of being watered down, right? I'm delegating it over to the junior reg accountant that's just only joined 3 months ago. So yeah, it is that level of accountability, right?
Yeah, and I think also I've seen a couple of cases where the first line, second line row happened. So, the first line said, oh no, that's a compliance function to produce the reports for the regulator. And the compliance going, no, that's like financial. It's a first line to produce your reporting. That's just a requirement of doing your business, right? And we'll check and challenge it. And to my mind, that is the case. It should be a first line operation, check and challenge by compliance. But if compliance are doing it all, they're busy, number one, they don't have large budgets, but also who's going to check and challenge them, right? Mm. So that's certainly an area that I'd be concerned about if people were just lobbing it over the wall into compliance,
Yeah, and lob it back to risk or someone. Yeah, that's the thing, right? There's so many levels of defense.
Yeah, and I think it's one of those things which is kind of one of the hardest challenges any of the larger firms face, because you've got to get multiple systems to work together effectively, and you've got to get multiple teams to work together effectively, who are all reporting to different people, all got different incentives, different priorities, etc. So this is where consultancy firms kind of thrive. It's a real transformational project. But, that's the nature of the beast. So, firms are not, they're already reporting in some shape or form. They already have some form of sign-off process. So it's just about getting it to a better place.
Yeah, is that formalizing it all, isn't it? And getting better documentation around the whole process and tightening it.
Correct. Yeah, I was on the board of a firm years ago who we got fine from the ECB. It was one of the first ECB fines around liquidity reporting. And it was just not recording things properly, not having proper policies and procedures, not checking and challenging. It was nothing. There was I think we made some assumptions wrong, but actually I think we had highlighted that it was a complicated area, and we'd highlighted to the regulator to say there was, we were confused by this. What did you think? And they then came in and slapped our wrist. But it was mainly around, yeah, but you haven't documented that. But we did it. Show me, prove me, all that sort of stuff. Yeah. Kind of annoying, right?
Yeah, well, that was the thing. I think I spoke to a consultancy firm and they said, when we get called in to kick the tires, effectively, before even going in, I could put down on my paper governance and controls. That's it's shocking, right? It's true. We've all seen it.
Yeah, I mean, I've also seen them. Like your question earlier was well made around, or your point around overdoing it. I have come across a couple of cases, one in particular where a consultant suggested that the board should review and sign off all regulatory reports. And then now that's a whole level of governance that to me is just nuts, because there's a amount of detail I as a non-exec or even a CEO is not going to know, right? They're not going to be able to check and challenge every single point. And so for me, the governance has to be around the process and the controls at the senior executive level, not the individual, January's number in cell C2, right? So I have seen overreach in terms of that people are trying to push those documents and those reports further up the structure to, oh, well, he's very important, so he should sign this off. That's not right. Yeah. They need to understand that. So there is two sides to it, and you don't want to go there in terms of senior sign off of individual reports, because that's just crazy.
Yeah. I think there's a level of overkill to have board members signing off on your monthly balance sheet report could be a bit of overkill.
A bit of a
to say the least. I kind of want to wrap up on one point actually, and I know we're talking about DCO 1 year on. I know you got how busy you guys are. So what's and the terms that we're talking to at the moment, and the budget cycle is going on between September and October. What's your kind of advice to firms if they are looking at budgets and compliance and things like that? It's a couple of key takeaways.
Yeah, I suppose it's to look at, as I said, what's your target operating model in this space? Really understand that. Make sure, as we've said, it's fit for purpose. And then I suppose spend wisely in automation. So from my mind, you want the target operating model first to understand what you want, and then go and look for your systems. But the more that you can automate checks and challenges in this, is far better. So it's not just about the system pulling data from, wherever it has to get it and spitting it out the right format. How can I wrap the controls and governance in the same system or in another system that's tied to it, if you know what I mean? So that it's really clear to me that all this thing is being done and it's being recorded. So somebody's doing a validation exercise in a model, it's recorded correctly. Somebody's checking the output or the assumptions, it's recorded. You know what I mean? But that has to come after your target operating model, understanding, what are we going to do? How are we going to do all this? And then put a system in to match that. But the more that you can automate this and use systems and get rid of spreadsheets, to be honest, and again, that was mentioned in the letter, not so much that you get rid of them, but the problem is they're not very good at evidencing what's happened, right? So a system that can evidence this, to me, is vital.
And I'd kind of add to that, if in the last year, you've done a gap analysis, you've gone through it, this is what we should be doing, this should be where we're heading. There's got to be a sense of priority around that, because you can't boil the ocean. You've actually got to pick a top 3 or whatever the number is of things that you're hoping to address in the short term, and that's where your funding's going to go. And you've also got to evidence to the regulators that you've gone through all of that process. These are the things you're going to spend your money on, and this is how you're going to track your process going forward. And Rich is absolutely right. You've got to put a framework in there which can be built on. The firm can actually, because this whole process will go on for a reasonable period of time, and it's got to then become the BAU operating model, target operating model, as Richard said. But for the moment, you're going for a transformational stage. But I would have thought, from the regulator's perspective, they're looking for people who've identified what are the key things they're doing, that put a plan in place, and they can evidence that they're progressing with that particular plan.
Yeah, very true. Gentlemen, thank you so much. I think I found some really good key takeaways from that in terms of the governance controls, target operating model, making sure it's robust. And spreadsheets is a whole different topic, right? I think we could be here for another few hours talking about spreadsheets and end user controls and all that. But guys, thank you so much for your time today, Richard and Paul, and thank you to everyone that's listening.